When we think about building wealth, many of us focus on earning, saving, and investing, rightfully so, as these are the key components of financial growth. But there's one aspect of wealth building that often goes overlooked until it's too late: the impact of estate taxes. Estate taxes can significantly reduce the amount of wealth you pass on to your heirs, and understanding how to navigate them is essential to preserving your legacy. Estate taxes may seem distant, something only to worry about in later years, but the reality is that planning for them early can have a profound impact on how much of your wealth is transferred after your death. Whether you're planning for the future of your family, the continuation of a business, or simply want to ensure your assets are passed down efficiently, understanding estate taxes is vital. Estate taxes are imposed on the transfer of assets after someone passes away, based on the total value of their estate. The idea behind estate taxes is that a portion of the deceased's wealth should go to the government. While this tax might seem like a distant concern, it is crucial to note that without proper planning, estate taxes can take a substantial portion of your wealth, leaving less for your loved ones. The good news is that there are strategies available to minimize estate taxes, and the earlier you start planning, the more options you'll have to reduce your tax burden. By understanding the fundamentals of estate taxes and taking proactive steps, you can significantly reduce the amount of wealth lost to taxes, ensuring that your family or beneficiaries receive more of your assets. Estate taxes are not only about taxes themselves, they're about the decisions you make today that will affect your financial legacy tomorrow. They're about providing your loved ones with the resources to carry on your legacy without the government taking more than it should. This is where estate planning comes in. A well-thought-out estate plan takes into consideration the value of your assets, how they will be distributed, and what steps you can take now to minimize the future impact of taxes. In this audiobook, we'll break down the basics of estate taxes in a way that's easy to understand, even if you have no prior knowledge of the subject. We will explore how estate taxes are calculated, what strategies are available to reduce them, and how to implement them in a way that suits your unique financial situation. You'll walk away with a clear understanding of the role estate taxes play in your wealth-building journey and the tools you can use to protect your assets and ensure that more of your wealth goes to your loved ones. Estate planning is not just for the wealthy. It's for anyone who wants to ensure that their hard work and investments benefit the people who matter most. By taking the time to learn about estate taxes, you're taking a crucial step in securing your legacy. Let's explore how you can minimize estate taxes and build a strategy that works for you and your family's future. Chapter 1. What are estate taxes? Estate taxes are often one of the most misunderstood and overlooked aspects of personal finance, particularly when people think about the legacy they will leave behind for their families. Many individuals may not consider estate taxes until later in life, or worse, until it's too late to plan effectively. Yet, understanding estate taxes is crucial for anyone who wants to preserve their wealth, minimize tax burdens, and ensure that the assets they worked so hard to accumulate go to their intended beneficiaries, rather than to the government. In this chapter, we will delve deeply into the concept of estate taxes, what they are, how they work, and why they are so important to include in your financial planning. We'll break down complex legal and financial jargon into simple, understandable terms, providing you with a clear overview of estate taxes and the tools available to manage them. Whether you're a young professional just starting to build your wealth or someone with an established estate, understanding estate taxes is a key step in ensuring the future of your assets. What exactly are estate taxes? At its most basic level, estate taxes are taxes levied on the total value of a deceased person's estate or the wealth that they leave behind. These taxes are paid by the estate itself, and they are based on the value of all the assets that the deceased person owned at the time of their death. This includes real estate, financial assets, investments, personal property, business interests, and even intangible assets, such as intellectual property. Essentially, when someone passes away, their estate is subject to taxation based on its value. The government taxes the estate before the assets are distributed to the heirs. This means that even before the beneficiaries inherit the wealth, the estate must pay a portion of its value to satisfy the estate tax. Key components of estate taxes. Gross estate. This is the total value of all assets the decedent owned at the time of their death. It includes everything from real estate properties and bank accounts to personal items such as jewelry and collectibles. The gross estate is the first figure used in estate tax calculations. Liabilities and debts. After calculating the gross estate, any debts owed by the decedent, such as mortgages, credit card balances, loans, or any other liabilities, are subtracted from the total value of the estate. This reduces the value that is subject to estate taxes. Net estate. The remaining value after debts and liabilities are subtracted is called the net estate. This is the value that is used to determine the estate tax owed. Estate taxes versus inheritance taxes. Before moving further into the details of estate taxes, it's important to clarify the difference between estate taxes and inheritance taxes, two terms that are often used interchangeably, but are, in fact, quite different. Estate taxes. These are taxes imposed on the deceased person's estate. The estate tax is paid before the assets are distributed to heirs. Essentially, the government collects its share of the estate's value before the beneficiaries receive their inheritance. Inheritance taxes. In contrast, inheritance taxes are paid by the beneficiaries who receive the assets. These taxes are imposed on the value of the inheritance that each beneficiary receives, and the rates may vary depending on the state and the relationship between the decedent and the beneficiary. Some states impose inheritance taxes, but the federal government does not. The main difference, therefore, is that estate taxes are paid by the estate itself, while inheritance taxes are paid by the heirs who receive the inheritance. Most people are more concerned with estate taxes because they apply to the entire estate's value before the distribution of assets, whereas inheritance taxes only affect certain beneficiaries in specific states. The estate tax exemption threshold. One of the key aspects of estate taxes that helps to determine whether your estate will be taxed is the estate tax exemption. This exemption sets a threshold, meaning that estates valued below a certain amount are not subject to estate taxes. The exemption amount changes from year to year, and it can vary depending on the legislation in place. As of 2025, the federal estate tax exemption is approximately $12.92 million per individual. This means that if the total value of your estate is below $12.92 million, you do not owe any federal estate taxes. For married couples, the exemption amount can be effectively doubled to around $25.84 million, thanks to a provision known as portability, which allows the surviving spouse to inherit the deceased spouse's unused exemption. The estate tax exemption is one of the most important aspects of estate planning because it determines whether you will owe estate taxes at all. If your estate's value exceeds the exemption threshold, the amount above that threshold will be subject to estate taxes. For estates over the exemption limit, the tax rate can be as high as 40%, which can significantly reduce the value of the estate that passes on to heirs. How are estate taxes calculated? Estate tax calculation involves several steps, starting with the determination of the estate's total value and subtracting any applicable deductions and exemptions. Let's break down the calculation process. Step 1. Calculate the gross estate. The first step in calculating estate taxes is determining the gross estate, the total value of all assets the decedent owned at the time of their death. This includes tangible and intangible property, such as real estate, stocks, bonds, life insurance policies, retirement accounts, and any other assets of value. For instance, if the decedent owned a home worth $1 million, stocks valued at $2 million, and a life insurance policy with a death benefit of $500,000, the gross estate would total $3.5 million. Step 2. Subtract liabilities and debts. Once the gross estate is determined, the next step is to subtract any liabilities or debts the decedent owed at the time of death. This may include mortgage balances, outstanding loans, credit card debt, taxes owed, or funeral expenses. For example, if the decedent had $200,000 in debts, including a mortgage and personal loans, these liabilities would be subtracted from the gross estate. So, the new value of the estate after liabilities would be $3.3 million. Step 3. Apply exemptions and deductions. After calculating the net estate value, you can apply any available exemptions or deductions. The most significant exemption is the federal estate tax exemption, which, as mentioned earlier, is around $12.92 million for individuals. If the decedent's estate is below this amount, no estate tax is owed. In addition to the exemption, there are other potential deductions available, including charitable donations. If the decedent made charitable donations during their life or left a portion of their estate to charity, those assets can be deducted from the estate's taxable value. Funeral expenses. The costs associated with the decedent's funeral and burial can be deducted. Estate administration costs. Costs incurred in managing the estate, such as attorney fees and executor fees, can be deducted from the estate value. By applying these deductions, the taxable value of the estate is further reduced, which can help minimize the estate tax burden. Step 4. Apply the estate tax rate. After determining the net taxable estate, the estate tax rate is applied. The estate tax rate is progressive, meaning it increases as the value of the taxable estate increases. The federal estate tax rate ranges from 18% to 40%, depending on the size of the estate. For example, if the taxable estate is $3.3 million and it exceeds the federal exemption limit, the portion above the threshold would be taxed. The rate applied depends on the specific tax bracket set by the IRS for the current year. If the taxable estate were $10 million and the exemption is $12.92 million, no estate tax would be due. However, for estates above the exemption limit, the excess value is subject to estate tax. The exact rate will depend on the value of the estate and any applicable deductions. State estate taxes. In addition to federal estate taxes, many states have their own estate or inheritance taxes. These taxes vary from state to state, and each state sets its own exemption threshold. Some states have no estate tax at all, while others impose taxes on estates valued at much lower thresholds. For example, in states like New York and Massachusetts, the estate tax exemption may be as low as $1 million. In these states, individuals whose estates exceed this threshold may be subject to estate taxes, even if they are well below the federal exemption limit. Conclusion: planning for estate taxes. Estate taxes can be a significant concern for individuals with larger estates, but they don't have to be a burden. By understanding the basics of estate taxes, how they are calculated, what they are based on, and the various strategies for reducing their impact, you can make more informed decisions about how to structure your estate plan. The key to minimizing estate taxes is early planning. Starting early gives you the flexibility to implement strategies like gifting, establishing trusts, or making use of exemptions, all of which can reduce the size of your taxable estate. Additionally, regular reviews of your estate plan will ensure that your plan evolves with your changing circumstances. In the following chapters, we will explore strategies for minimizing estate taxes and creating a comprehensive estate plan that reflects your wishes, provides for your loved ones, and ensures that your wealth is passed on efficiently. Understanding estate taxes is just the beginning. Now it's time to take control of your estate and your legacy. Chapter 2: How estate taxes are calculated. Estate taxes, often referred to as death taxes, are an essential but sometimes complex part of wealth transfer. If not properly planned for, these taxes can diminish the amount of wealth passed down to heirs. This chapter will break down how estate taxes are calculated, helping you understand the steps involved and the factors that influence the tax calculation. By understanding the process of estate tax calculation, you can take proactive steps to reduce the tax burden and preserve more of your estate for future generations. Estate tax calculations may seem daunting, but they follow a set of straightforward steps that can be broken down into manageable pieces. Let's dive into the calculation process and explore the key elements that determine how much estate tax may be owed upon your death. Step 1. Determining the gross estate value. The first step in calculating estate taxes is to determine the gross estate value. This is the total value of all assets owned by the decedent at the time of their death. The gross estate includes everything the deceased person owned, both tangible and intangible property. These assets will be added up to calculate the initial value of the estate before any deductions are made. What is included in the gross estate? The gross estate includes a wide variety of assets. To make sure you capture the total value of your estate, let's break down the main types of assets that are included. Real property. This refers to any real estate owned by the decedent, including their primary residence, secondary homes, such as vacation properties, rental properties, and commercial real estate. The value of these properties is typically assessed based on their fair market value at the time of death. For example, if the decedent owned a family home worth $500,000, this would be added to the gross estate value. Bank accounts and financial assets. All bank accounts, whether checking, savings, CDs, or money market accounts, must be included in the gross estate. Additionally, investment accounts such as brokerage accounts, mutual funds, stocks, and bonds are part of the gross estate. These are typically valued based on the market value at the time of the decedent's death. Retirement accounts. Retirement accounts such as 401ks, IRAs, and pensions are included in the estate's gross value. While the specific rules for taxation may vary, the overall value of these accounts is considered part of the decedent's estate, and the beneficiary will inherit these accounts based on the plan's rules. Life insurance. Life insurance policies are often a significant part of an individual's estate. If the decedent held the policy and it is payable to their estate, the life insurance proceeds will be included in the gross estate. However, if the policy was placed in an irrevocable life insurance trust, ILIT, the proceeds may not be included. Personal property. This includes tangible items such as jewelry, artwork, collectibles, antiques, furniture, and vehicles. The value of these items is determined through appraisals, and they must be added to the estate's total value. For instance, if the decedent owned a valuable collection of fine art valued at $200,000, this would contribute to the gross estate value. Business interests. If the decedent was a business owner, the value of their business interests is included in the gross estate. This can include shares of stock in a privately held company, partnership interests, or ownership in a family business. Business valuation can be complex and may require a professional appraiser to determine the fair market value of the business at the time of death. Other assets. Other assets that may be part of the gross estate include intellectual property, such as copyrights or patents, royalties, or any other assets the decedent owned at the time of death. The value of these intangible assets should also be included in the gross estate. It is important to keep in mind that the gross estate value is not static, it fluctuates with market changes. For instance, if the market value of stocks or real estate drops significantly before the decedent's passing, the gross estate value may be lower than initially anticipated. Step 2. Subtracting liabilities and debts. After determining the total value of the gross estate, the next step is to subtract any liabilities and debts that the decedent owed at the time of death. These debts reduce the value of the estate subject to estate tax. What is included in liabilities? Common liabilities that can be deducted from the gross estate include mortgages. If the decedent had a mortgage on their home or any other property, the outstanding mortgage balance will be subtracted from the estate's gross value. For example, if the decedent's home had a mortgage balance of $150,000, that amount would be deducted. Loans. Any other loans the decedent had, whether personal loans, auto loans, or business loans, are considered liabilities and should be subtracted from the estate's gross value. Credit card debt. Credit card balances and any other outstanding unsecured debts must be subtracted as well. Unpaid taxes. If the decedent owed any income taxes, property taxes, or other types of taxes, these amounts must also be deducted from the estate's gross value. Funeral expenses. The costs associated with the decedent's funeral and burial are also considered part of the estate's liabilities and can be deducted. Estate administration costs. Any expenses incurred in managing and settling the estate, such as executor fees, attorney fees, and court costs, can also be deducted from the estate's value. Once all of these liabilities are subtracted from the gross estate, the remaining value is called the net estate. This is the value on which estate taxes are calculated. Step 3. Applying estate tax exemptions and deductions. Once the net estate is determined, you can apply various exemptions and deductions that will reduce the taxable estate. The most significant of these exemptions is the estate tax exemption. The federal estate tax exemption. The federal estate tax exemption is the amount of your estate that can be passed on to heirs without being subject to estate taxes. As of 2025, the exemption amount is approximately $12.92 million per individual. This means that if the value of your estate is less than $12.92 million, your estate will not owe any federal estate taxes. For married couples, the exemption is effectively doubled, so they can pass on up to $25.84 million without incurring estate taxes. The estate tax exemption is one of the most important tools for reducing estate taxes. If your estate is below the exemption threshold, there's no need to worry about estate taxes at all. However, for estates exceeding the threshold, the amount above the exemption is subject to estate taxes. State estate taxes. In addition to the federal estate tax, many states impose their own estate or inheritance taxes. These state taxes often have much lower exemption thresholds, meaning that estates below the federal threshold may still owe estate taxes at the state level. Some states, like New York, Massachusetts, and Oregon, impose estate taxes on estates valued over a few $1 million. The rates and exemption limits vary from state to state, so it's important to be aware of your state's laws when planning your estate. Deductions, charitable contributions, and other costs. In addition to the exemption, you may also be able to claim deductions to reduce the taxable estate. One of the most common deductions is for charitable donations. If part of your estate is donated to charity, you can deduct the value of those donations from your estate's value, reducing the amount subject to estate tax. This strategy can both reduce taxes and support causes you care about. Other allowable deductions include funeral expenses. As mentioned earlier, funeral expenses can be deducted from the estate. Estate administration fees. The costs of administering the estate, such as legal fees, executor fees, and other administrative costs, can also be deducted from the estate's taxable value. Once all exemptions and deductions are applied, the result is the taxable estate, or the amount subject to estate taxes. Step 4. Applying the estate tax rate. Once the taxable estate is determined, the estate tax rate is applied. Estate tax rates are progressive, meaning that the tax rate increases as the value of the estate increases. For estates that exceed the exemption limit, the tax rates can range from 18% to 40% on the amount above the exemption threshold. For example, if the estate's taxable value is $3 million and the federal exemption is $12.92 million, no estate tax will be owed. However, if the taxable estate exceeds the exemption amount, the estate is subject to a progressive tax rate. The tax rates increase in brackets, and higher portions of the estate value are taxed at higher rates. Conclusion: the importance of planning for estate taxes. Calculating estate taxes is a multi-step process that involves determining the value of the estate, subtracting liabilities, applying exemptions, and finally calculating the tax due. While this process may seem daunting, it is a critical part of estate planning, especially for individuals with significant assets. By understanding how estate taxes are calculated, you can take steps to minimize their impact on your estate. The key to reducing estate taxes lies in effective planning. Gifting assets, setting up trusts, and leveraging exemptions are all strategies that can reduce the size of your taxable estate and minimize the tax burden on your heirs. In the following chapters, we will explore these strategies in detail, giving you the tools and knowledge you need to protect your wealth and ensure that your legacy endures. Chapter 3: Ways to minimize estate taxes. Estate taxes can be a significant burden on your wealth after you pass away, especially if your estate exceeds the exemption threshold. However, there are various strategies available to minimize estate taxes, preserve more of your wealth for your heirs, and ensure that your estate planning aligns with your financial goals. In this chapter, we will explore a variety of methods you can use to reduce estate taxes, ranging from simple gifting strategies to more complex tools like trusts and life insurance. While some of these strategies require careful planning and attention to detail, the benefits of reducing estate taxes can be substantial. With the right approach, you can ensure that your loved ones inherit more of your wealth and that you retain control over your financial legacy. Let's dive into the most effective ways to minimize estate taxes and how you can begin implementing them in your own estate plan. 1. Utilize the estate tax exemption. One of the simplest ways to minimize estate taxes is by utilizing the estate tax exemption. As of 2025, the federal estate tax exemption is approximately $12.92 million for individuals and $25.84 million for married couples. This means that if the total value of your estate is below this threshold, no federal estate taxes will be owed. The estate tax exemption allows individuals and couples to transfer a significant amount of wealth to heirs without incurring federal estate taxes. If your estate is valued below the exemption threshold, you may not need to worry about estate taxes at all. Portability for married couples. For married couples, the exemption is doubled due to the concept of portability. This allows the surviving spouse to inherit the unused exemption of the deceased spouse, effectively doubling the amount of wealth that can be transferred without incurring estate taxes. For example, if one spouse passes away and their estate is valued at $5 million, they will not have used up the full $12.92 million exemption. The surviving spouse can then apply the unused exemption to their own estate, further reducing estate taxes. While portability is a valuable tool for married couples, it requires specific planning. The surviving spouse must elect to use the portability option on their tax return, so it's important to work with an estate planner to ensure this is properly executed. 2. Gifting assets during your lifetime. One of the most effective ways to reduce the taxable value of your estate is to gift assets to your heirs during your lifetime. The IRS allows individuals to give away up to a certain amount each year without incurring gift taxes. This annual gift exclusion is set at $17,000 per recipient in 2025. You can gift this amount to as many people as you like each year, reducing the size of your estate while helping your loved ones during your lifetime. In addition to the annual gift exclusion, there is a lifetime gift exemption of up to $12.92 million. the same as the estate tax exemption. This allows you to make larger gifts to your heirs without triggering gift taxes, as long as the total value of the gifts remains under the exemption threshold. For example, if you want to transfer $1 million to your children, you can do so without paying gift taxes, provided you still have room under your lifetime exemption. By gifting assets during your lifetime, you reduce the total value of your estate, which could potentially lower your estate tax liability. It's also a great way to see the positive impact of your wealth on your heirs while you're still alive. 3. Establishing trusts to minimize estate taxes. Trusts are powerful tools for reducing estate taxes, providing you with more control over your assets and ensuring that your wealth is passed on according to your wishes. There are several types of trusts, each serving a different purpose in estate planning. Here are the most commonly used trusts for minimizing estate taxes. Irrevocable Life Insurance Trust, ILIT. An irrevocable life insurance trust, ILIT, is a trust designed to remove life insurance proceeds from your taxable estate. When you purchase life insurance, the death benefit is typically included in your estate for tax purposes. However, if the policy is placed in an ILIT, the death benefit will not be included in your estate, meaning your heirs can receive the payout without it being subject to estate taxes. An ILIT is particularly useful for high net worth individuals who want to ensure that their heirs receive the life insurance benefits without increasing the size of their taxable estate. Additionally, an ILIT can be structured to provide your beneficiaries with more control over the life insurance payout, such as distributing the funds in installments rather than as a lump sum. Charitable trusts. Charitable remainder trusts, CRTs, and charitable lead trusts, CLTs, are designed to benefit both charitable organizations and your heirs. These types of trusts allow you to donate assets to charity while retaining some benefit for your family and receiving tax benefits. Charitable Remainder Trust, CRT. A CRT allows you to donate assets to a charity while retaining an income stream for a set period, such as your lifetime. When the trust ends, the remaining assets go to the charity, and the estate receives a charitable deduction. CRTs can be an effective way to reduce estate taxes while supporting causes that are important to you. Charitable-led trust, CLT. A CLT works in reverse, where the charity receives an income stream for a set period, and the remaining assets are passed on to your heirs. CLTs can reduce your taxable estate by removing the assets from your estate, and the charitable donation may provide an estate tax deduction. Both types of charitable trusts can help reduce estate taxes while leaving a legacy for charitable organizations and passing on wealth to your family. Grantor Retained Annuity Trust, GRAT. A grantor retained annuity trust, GRAT, allows you to transfer assets to your heirs while retaining an annuity, a fixed income stream, for a set period. At the end of the trust term, the remaining assets pass to your beneficiaries, typically with little or no estate tax liability. The key to a GRAT's effectiveness in reducing estate taxes is that the value of the gift is determined by subtracting the present value of the annuity from the total value of the assets. If the assets appreciate during the trust term, any growth above the annuity amount passes to your heirs without being subject to estate taxes. 4. Leveraging Family Limited Partnerships, FLPs. A family limited partnership, FLP, is a legal entity that allows family members to pool assets for the purpose of managing investments, real estate, and other wealth. The general partner, often the parent or senior family member, manages the FLP, while other family members are limited partners. One of the primary advantages of an FLP is that it allows you to transfer ownership interests in the partnership to your heirs, while keeping control of the assets. By gifting ownership interests in the FLP to family members, you can reduce the value of your estate while maintaining control over the management of the assets. FLPs also offer valuation discounts on the transfer of ownership interests. which means that the transferred assets may be valued lower than their actual worth, reducing the taxable estate. 5. Making use of education and medical exclusions. Another way to reduce estate taxes is by taking advantage of the IRS exclusions for education and medical expenses. If you pay for someone's education or medical expenses directly to the provider, that is to say, a school or hospital, these payments are not considered taxable gifts and do not count toward your lifetime gift exemption. For example, if you want to help pay for your grandchildren's education or cover their medical expenses, you can do so without incurring gift taxes, as long as the payments go directly to the educational institution or medical provider. These types of payments are a great way to help your loved ones while also reducing the overall value of your taxable estate. 6. Gifting assets to spouses. Under current law, you can gift unlimited assets to your spouse without incurring gift taxes, thanks to the unlimited marital deduction. This strategy allows you to transfer assets to your spouse during your lifetime or at death without worrying about estate taxes. While this strategy can be effective for reducing estate taxes during your lifetime, it's important to note that the assets will be included in your spouse's estate when they pass away. However, the estate tax burden may be deferred until the second spouse's death, and by that time, the estate may be able to take advantage of the marital deduction and other estate planning strategies. 7. Using annual gift exclusions and lifetime gift exemption. The annual gift exclusion allows individuals to give away up to $17,000 per person per year as of 2025 without triggering gift taxes. This means that you can gift assets to multiple individuals, children, grandchildren, friends, without worrying about hitting your gift exemption limit. For married couples, this amount is effectively doubled to $34,000 per recipient each year. Additionally, you can combine the annual exclusion with the lifetime gift exemption, which is tied to the estate tax exemption of $12.92 million in 2025. This allows you to gift more substantial amounts to your heirs over time, reducing your taxable estate while helping your family. Conclusion: reducing estate taxes through planning. Estate taxes don't have to be a burden on your legacy. By utilizing the strategies we've discussed, such as gifting during your lifetime, creating trusts, taking advantage of exemptions, and using marital deductions, you can significantly reduce the amount of estate taxes owed. The earlier you start planning, the more flexibility you'll have to structure your estate in a way that minimizes tax liability and maximizes the wealth passed on to your heirs. Estate planning isn't just about minimizing taxes. It's about making sure that your assets are distributed according to your wishes, protecting your loved ones, and ensuring your legacy endures. By working with a knowledgeable estate planner and implementing the right strategies, you can create a financial future for your heirs that is tax-efficient and aligned with your personal goals. The steps you take today can make a lasting difference for generations to come. Chapter 4. Planning for the Future. Estate planning is an essential step in preserving your wealth and ensuring that your assets are distributed according to your wishes after you pass away. While many people focus on saving and growing their wealth during their lifetimes, planning for the future and considering how your estate will be handled when you are no longer around is equally important. Proper estate planning not only helps you reduce estate taxes but also provides peace of mind, knowing that your family, beneficiaries, and loved ones will be taken care of. In this chapter, we will explore the key components of effective estate planning, focusing on how you can structure your estate in a way that minimizes taxes, maximizes asset protection, and ensures that your legacy is protected. We will also discuss how to handle potential complications and challenges, and why it's critical to start planning for the future today, regardless of your age or current wealth. 1. The importance of estate planning. Estate planning is often seen as something for the wealthy, or something to put off until retirement. However, the reality is that estate planning is for everyone, regardless of the size of your estate. Whether you have a small portfolio of assets or a large estate, having a plan in place is essential. Without an estate plan, your assets may be subject to lengthy legal processes like probate, and your wishes may not be honored. Furthermore, your family could be left facing a significant estate tax burden that could have been minimized with careful planning. By having a well-thought-out estate plan, you ensure that your assets are distributed according to your wishes. Your loved ones are protected from financial hardship. Your estate is managed efficiently and in a timely manner, avoiding unnecessary legal fees. You minimize the impact of estate taxes, maximizing the wealth passed on to your heirs. Estate planning is a way of taking control over how your wealth is transferred, and it provides a roadmap for your loved ones to follow in the event of your passing. 2. Key components of an estate plan. To begin building an effective estate plan, it's important to understand the key components that make up a comprehensive estate plan. These components will help you manage and distribute your wealth according to your wishes, while minimizing the tax burden on your heirs. Wills and trusts. The foundation of any estate plan is a will, a legal document that specifies how your assets should be distributed after your death. It is essential for ensuring that your wishes are followed and that your estate is distributed according to your desires. A will allows you to name an executor who will be responsible for managing your estate and ensuring that your assets are distributed to your beneficiaries. While a will is a fundamental part of an estate plan, it may not be sufficient for everyone. Trusts are another essential tool for estate planning, particularly when it comes to minimizing estate taxes and providing for your beneficiaries in a controlled manner. Trusts are legal arrangements that allow you to transfer assets to a trustee who will manage and distribute those assets according to your instructions. There are different types of trusts, each serving different purposes. Some of the most common include revocable living trusts. These allow you to maintain control over your assets while you're alive, and they automatically pass on assets to your beneficiaries when you die, avoiding the probate process. Irrevocable trusts. These remove assets from your estate entirely, helping to reduce the taxable value of your estate. They also offer asset protection, shielding your wealth from creditors and lawsuits. Charitable trusts. These allow you to donate assets to charity while retaining some benefits, reducing estate taxes, and leaving a charitable legacy. Powers of attorney and healthcare directives. In addition to a will and trust, there are other important documents that form part of your estate plan. These include a durable power of attorney and healthcare directives, which ensure that someone you trust can make financial and healthcare decisions on your behalf if you become incapacitated. A durable power of attorney grants someone the authority to manage your finances, pay bills, and make decisions regarding your assets if you become unable to do so yourself. This is crucial in the event that you experience an illness or injury that leaves you unable to manage your affairs. A healthcare directive, also known as a living will, outlines your preferences for medical treatment in the event that you cannot communicate those preferences yourself. This document helps ensure that your healthcare decisions are honored and provides guidance to your loved ones and medical professionals. Beneficiary designations. In addition to a will and trust, you should ensure that your beneficiary designations on financial accounts, retirement accounts such as IRAs or 401ks, and life insurance policies are up to date. These designations determine who will receive the assets in these accounts after your death, and they take precedence over the instructions in your will or trust. It's important to review your beneficiary designations regularly, especially after major life events such as marriage, divorce, or the birth of a child, to ensure that your assets go to the intended recipients. Keep in mind that these designations can sometimes override the instructions in your will, so they should be kept current. 3. Minimizing estate taxes through strategic planning. One of the primary goals of estate planning is to minimize estate taxes. While estate taxes are unavoidable for estates that exceed the exemption threshold, there are several strategies you can use to reduce the taxable value of your estate. Below, we'll explore some of the most effective tax-saving strategies. Gifting assets. One of the easiest ways to reduce your taxable estate is by gifting assets to your heirs during your lifetime. The IRS allows you to gift up to $17,000 per recipient per year as of 2025 without incurring gift taxes. This is called the annual gift exclusion. If you're married, you and your spouse can each give $17,000, effectively doubling the amount you can transfer to a single person each year. Additionally, there's a lifetime gift exemption that allows you to make larger gifts without paying gift taxes, as long as you don't exceed the federal estate tax exemption, currently $12.92 million per individual, $25.84 million for married couples. By strategically gifting assets during your lifetime, you can reduce your estate's value and avoid the hefty estate tax bill. Establishing trusts. As we discussed earlier, trusts are valuable tools for reducing estate taxes. By transferring assets into an irrevocable trust, you remove those assets from your taxable estate, which lowers the overall value of the estate subject to taxes. In some cases, assets in a trust may also grow without being subject to estate taxes, allowing you to retain more of the wealth for future generations. Charitable trusts, in particular, are effective at reducing estate taxes. By donating assets to charity, you can claim a charitable deduction and reduce the value of your taxable estate while supporting causes you care about. This strategy not only reduces taxes, but also allows you to leave a lasting legacy. Life insurance. Using life insurance as part of your estate plan can also help manage estate taxes. Irrevocable life insurance trusts, ILITs, are commonly used to keep life insurance proceeds out of your taxable estate. When life insurance policies are placed in an ILIT, the death benefit is not included in the value of your estate, and your beneficiaries receive the full payout tax-free. This is especially important for high net worth individuals who have large life insurance policies. Life insurance can also provide liquidity to your estate, ensuring that your heirs have the funds they need to pay any estate taxes that may be due. This can prevent the forced sale of assets to cover tax liabilities. 4. Updating your estate plan as life changes. Estate planning is not a one-time task. It's an ongoing process that should be reviewed and updated regularly. Major life events can significantly affect your estate plan, and failing to update your documents can lead to unintended consequences. Major life events to consider. Marriage or divorce. Marriage or divorce may change your financial situation, and you may need to update your will, trusts, and beneficiary designations to reflect your new family dynamics. Birth or adoption of children. If you have children or adopt new family members, it's important to update your estate plan to include them as beneficiaries or appoint guardians if you have minor children. Changes in financial status. If your financial situation improves or worsens through a significant inheritance, a large financial windfall, or a change in business interests, you may need to adjust your estate plan to account for the increase or decrease in assets. Death of a spouse or beneficiary. If a spouse or beneficiary passes away, you'll need to update your estate plan to reflect the change in your family structure and ensure that your wishes are properly executed. 5. The role of professionals in estate planning. Estate planning can be complex, especially when it comes to managing taxes, trusts, and other financial strategies. Working with professionals such as estate planners, financial advisors, and tax specialists is essential to creating a comprehensive plan that meets your goals. An estate planner can help you navigate the intricacies of the law and ensure that your estate plan is legally sound. Financial advisors can provide insights into how to manage your investments and assets in a tax-efficient manner. Tax specialists can help you identify ways to minimize estate taxes and take advantage of tax-saving opportunities. Conclusion. Planning for a secure future. Estate planning is one of the most important steps you can take to ensure that your wealth is passed on according to your wishes, with minimal tax burdens for your heirs. By using tools like wills, trusts, and life insurance, and by taking proactive steps to reduce estate taxes, you can protect your legacy and provide for your loved ones. Estate planning isn't just for the wealthy. It's for anyone who wants to secure their financial future and provide a lasting legacy. The earlier you start planning, the more options you'll have, and the more control you'll have over how your wealth is distributed. Ultimately, estate planning is about peace of mind. By planning for the future today, you can ensure that your family is protected, your wishes are honored, and your wealth is preserved for generations to come. Whether you're just starting or revisiting your existing plan, taking the time to engage in thoughtful estate planning will give you the confidence that your financial future is secure. As we conclude this exploration of estate planning and minimizing estate taxes, it's clear that the process is not just about protecting wealth, it's about taking control of your legacy and ensuring that your hard-earned assets are passed on according to your wishes. Estate planning allows you to dictate how your wealth will be distributed, who will care for your loved ones, and how you will be remembered for generations to come. It's about more than just minimizing tax burdens. It's about creating a structure that aligns with your values, goals, and aspirations for the future. By understanding the fundamentals of estate taxes, the importance of proper planning, and the strategies available to reduce tax liabilities, you are already on the right path. The key takeaway is that planning for your future, no matter the size of your estate, is a crucial step in preserving wealth and ensuring the financial security of your family. This isn't something to delay or put off. It's something to embrace as part of your broader financial strategy. Estate planning doesn't have to be complex, and it doesn't need to be reserved for the super wealthy. The strategies we've discussed, gifting during your lifetime, establishing trusts, using life insurance policies, and making the most of exemptions and deductions are practical steps that anyone can take to ensure that their wealth is preserved and passed on in the most tax-efficient way. These steps not only protect your assets, but also give you peace of mind knowing that your heirs will have the resources they need to continue building on the foundation you've laid. It's also essential to recognize that estate planning is a dynamic, ongoing process. Life events such as marriage, the birth of children, career changes, and even changes in tax laws will all affect how you approach estate planning. Regularly reviewing and updating your estate plan ensures that it remains aligned with your goals and responsive to changes in your life. By revisiting your plan and making necessary adjustments, you continue to exercise control over your legacy, making sure that your wishes are honored no matter what comes your way. Perhaps the most important message to take from this audiobook is that estate planning is a personal journey. It's about understanding what matters most to you and ensuring that your values are reflected in the distribution of your wealth. Whether it's providing for your children's education, supporting a charity that's close to your heart, or leaving a lasting legacy for future generations, you have the power to shape your financial future and influence how your legacy will live on. You don't need to be an expert in tax laws or financial strategies to create an effective estate plan. With the right guidance from professionals, whether it's an estate planner, financial advisor, or tax expert, you can create a plan that serves both your needs and the needs of your family. The key is to start early, stay informed, and make thoughtful, deliberate choices that will protect your wealth and ensure that your estate plan reflects the future you envision. In the end, estate planning is not just about money, it's about the stories, values, and lessons you leave behind. It's about ensuring that your wealth benefits those you love and those causes you care about. By taking control of your estate and implementing a solid, strategic plan, you can rest assured that your legacy will endure just as you intended.